Let's dive into exactly what is moving this crazy uranium market. So if we first start with the price action on the week, that Sprott Uranium Miners ETF was up 2.25%, massively diverging from the NASDAQ composite, down 2.79% on the week. We're entering a stagflationary period where supply chain disruptions, high inflation, slow growth, high interest rates all culminate into a favorable environment for resources historically. And so maybe we're starting to see a divergence, or maybe the fundamentals of the uranium market are just too good to ignore. So we're seeing the uranium spot price dipping further. The screw is just getting tighter. What I love about this is the further the price goes, the worse the supply crunch gets, because there's going to be less and less supply coming onto the market, as miners are not incentivized to put any on the market and sell into these ridiculously undervalued prices. And so bad news is good news in this case. Looking at the NASDAQ, you can see uranium a victim of the sell-off in the broader, wider market, the liquidity event that is taking place. NASDAQ dipping. Are we repeating a similar pattern to what took place the last time we had stagflationary supply chain issues in the US and global economy? Is the stock market having its first dip down in a very volatile session, just like we saw back in the 1970s? Now you have people like Ray Dalio talking about how we are in a period like the 1970s. People on our show have been talking about this for a long time. Well, it seems like it's unfolding. We have a collapsing stock market, rising rates. Eventually, commodities diverged in that environment. Resource stocks did really well. We're still monitoring that. This last week, uranium stocks outperformed, but we'll stay on top of this. Regardless, looks like we're due for a bounce in the market as we get a volatile, choppy session, and traders get utterly manipulated and the shorts get squeezed. Let's go into this article from Reuters. Unloved since Fukushima, uranium is hot again for miners. So let's go into the math underlying the bullish uranium thesis. There are about 440 nuclear power plants around the world that require approximately 180 million pounds of uranium every year. So keep that number in your mind, 180 million pounds of uranium every year. Uranium mines produce about 130 million pounds, a deficit that mining executives predict will widen even if idled capacity by major producers such as Camco and Kazakhstan's Kazatomprom come back online. This is the supply-demand deficit broken out. Here's the math: 50 million pounds per year in deficit. And that's why I get excited when the spot price comes down, because it just speaks to the violent counter reaction that's going to happen once this deficit gets filled and the spot price pumps to fill this gap. So that's the math. That's the setup. Let's dig deeper into this article, which summarizes what is going on. Prices have retreated since a peak in April, but the CEO of Sprott Asset Management, which runs the Sprott Physical Uranium Trust, which is also taking millions of pounds of supply off the market every year in this deficit environment, told Reuters Moscow's invasion had shifted the energy markets dramatically. Now the theme is about energy security, energy independence, trying to move away from Russian origin energy supply chains. So now miners are dusting off feasibility studies for mothballed mines and reviving projects. In Australia, uranium producers, including Paladin Energy Limited, which aims to restart its Langer Heinrich uranium mine in Namibia, idled over a decade ago. They've raised $280 million US over the last 6 months to fund exploration and resuscitate mines. With all the additional demand that's coming from the new nuclear plants, the thesis is that over a 5 or 10 year period, that additional demand will just dwarf those volumes coming back to market. And so this is the thesis for the uranium investment long term. These guys who are pumping money into this space have done the math. They realize that in the next 5 or 10 years, the demand is going to outweigh the supply continuously, as it's already doing. China plans to build 150 new reactors between 2020 and 2035, and Japan also aims to boost nuclear capacity, as does South Korea. In Europe, Britain has committed to build 1 new nuclear plant every year, while France plans to build 14 new reactors, and the European Union has proposed counting nuclear plants as a green investment. This doesn't even talk about the renaissance happening in America. So this is the setup. We've talked about it. Just wanted to summarize it for you before we dig into the nuclear news on the week and the nitty-gritty of what is moving these markets. So what is going on geopolitically? We know it's because of this Russian war in Ukraine. What is the current status of that? It's not great, and it's just escalating. Biden signs a $40 billion Ukraine aid package as Russia steps up assault in the east. Look forward to new powerful defense assistance, Ukraine's president said. Today, it is needed more than ever. This war is not going away. It's a war of attrition. Russia's going to throw everything they can at Ukraine, and Ukraine's just going to defend itself. And that's just going to alienate Russia, and it's going to alienate Russian resources from the rest of the world. And so you have a scramble to stop Russian uranium fueling Britain's nuclear power. Around the world, these nuclear power plants are boycotting Russian nuclear power. Western countries are going to boycott it, and they're going to go after it wherever they can find it. And they're only going to be able to find it in the much higher cost, more expensive produced uranium mines in the West outside of the Russian orb of influence. Brussels to help EU countries end reliance on Russian nuclear fuel. European Commission will assist in speeding up the process of licensing alternatives. There's a scramble. Everyone wants to move away from Russia into the arms of the producers, which are going to give it to these guys at a much higher price. It's economics 101, these mines need to make a profit. This is where it gets really interesting. Kazakhstan, which we know is really close to Russia and China, right? The Eastern Bloc, the new Iron Curtain that's going up. Which side will Kazakhstan join? Well, Kazakhstan is trying to have it both ways, assuring Western nuclear fuel buyers that it is not aligned with Russia, while at the same time negotiating with Russia to invest in Kazakh uranium mining projects to reinforce their joint energy security. Which way will they go? They're trying to remain neutral. It is very difficult to remain neutral in cold and hot wars like this. If the Russian side expressed a keen interest in investing in Kazakhstan's uranium mining industry to reinforce the energy security of the two countries, then they're getting close to each other, and buying Kazakhstan uranium may be linked up and may be associated with buying Russian uranium. And who knows what'll happen when people want to start banning Kazakhstan uranium, because it's going to benefit its Russian investors. You have to stay on top of that situation because of the massive amount of uranium that's coming from this area. And so it's adding fuel to the fire, these geopolitical issues. Obviously, we've talked about the supply demand fundamentals, the math behind it. Well, this is just making things worse and better for the long-term prospects of a rising uranium spot price. Top 5 uranium stocks to consider on severe supply issues. So let's check out some of these companies and some developments of these companies that are well positioned to take advantage of the shift in supply chains west. Uranium Energy Corporation reported that it has now secured an additional 400,000 pounds of U.S. warehoused uranium, expanding its physical uranium program to 5 million pounds, with delivery dates out to December 2025 at a volume weighted average price of $38 per pound. UEC's physical uranium program represents an unrealized gain of over $125 million based on the current spot price. So these guys are profiting, but let's see how fast all their supply is gobbled up. Regardless, they're making a fortune as the prices go up. Now, this isn't going to fix the supply-demand deficit, but it's good for UEC. A year ago, UEC launched a physical uranium portfolio with 500,000 pounds purchased at a uranium cost basis at less than $30 per pound. The company has grown the size of our inventory over tenfold to 5 million pounds by making well-timed purchases near cycle lows that allow us to maintain a low-cost portfolio of $38 per pound. At a time of heightened geopolitical uncertainty, UEC has the benefit of secure U.S. warehouse physical inventories. We have also staged our deliveries to receive uranium as far out as December 2025, providing a low-cost stream of physical uranium as we enter this uranium bull market that shows a major structural supply deficit exceeding 215 million pounds by 2026. That says it all. Moving on, Denison Mines Corporation. Denison remains committed to holding its physical uranium position for the long term as both a means to enhance our shareholders' exposure to the uranium market and a tool for the future financing of the development of the Wheeler River project. At the end of the first quarter, Denison's physical uranium holdings had a market value of approximately $181 million, representing about 60% of Denison's share of the initial capital costs estimated for the Wheeler River project in the pre-feasibility studies. So this geopolitical uncertainty is increasing the value of the physical uranium on hand at Denison, and they're going to use it to fund further exploration. Energy Fuels, strategically located in the US and North America, just like these others, reported its financial results for the quarter ended March 31, 2022. Energy Fuels continues to benefit from increases in the prices for all of the critical elements and materials we produce. Though volatile, uranium prices have continued to exhibit strength and resilience, which we expect to continue as Russia's invasion in Ukraine continues. As a result of Russia's aggression, we believe domestic and global nuclear utilities are reducing ties with the Russian state-owned nuclear company. We also believe U.S. uranium and nuclear fuel suppliers may be seeing increased interest from U.S. utilities as a result of the $6 billion civil nuclear credit program, which prioritizes reactors that purchase nuclear fuel and uranium from U.S. suppliers, which would include Energy Fuels. So these uranium mining insiders obviously know what they're talking about. They're reiterating the thesis for the uranium investor that we've been harping on for over a year now on this show, on this channel, and will stay on top of the market as the supply crunch continues to get worse and worse. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.